In this third and final lecture in this mini-series, I'm going to show you how to utilize VWAP on days when the market is ranging in an effort to optimize your trading strategy. Now, in the previous two lectures, I spoke about using VWAP as a key level or using it as a target. The VWAP can be extremely useful to keep you out of trouble on a ranging day. Now, for most traders, ranging days are the toughest to master. Nearly everybody can make money on a trending day, okay? The momentum that a trending day has, it can seduce you into thinking your skills are higher than they actually are. But take away the momentum, and suddenly the poor choice of a trading location will come back to hit you right across the face. Whenever you get that beginner's luck, and you might get a trending day, so you make some money, but then I've seen traders run into a ranging day, and they will trade themselves out of all monthly profits in that one day. So obviously, that is definitely something we want to avoid. I'm an active funded prop trader myself. I trade every single day and I run daily live trading sessions right here on YouTube. But I'm also a pretty well-known performance coach. So when people first come to me for coaching, they will, without a fail, attempt to use setup and strategies that are only appropriate on trending days. And when faced with the challenges of range-bound days, the most frequently asked question that I get, well, why can't we just avoid neutral and ranging days altogether? Now, some of you have seen this already. If we look at crude oil, so I have crude oil and gold here. Gold is blue, crude oil is red. If I look at the last 252 days, that's the last 12 months, but actually, if you go back many years, this sort of relationship actually remains pretty consistent throughout the years. We're talking like many years, certainly for 15 years that I've been trading. One thing that you can figure out from this is that true trending days really only happen 35% of the time for crude oil, 42% of the time for gold, whereas neutral days and limited auction days, which I define as any day that attempts to leave the first hour of the trading range, but then returns to the first hour trading range and stays there until the end of the session, numbers don't lie. So here we have neutral days and limited auction days that vastly outnumber the trending days. Put these two together and you have 54 to 56 days of the entire year where the market is not trending. So what? Are we supposed to just not trade more than half of the days in a year? Then you can't be a profitable day trader. If you only make money on trending days and then mess it up on all the other 55% of the days, that's a disaster. You'll never be profitable like that, ever. This is why you have to master the ranging days. Now, some products, such as gold, they have a higher incidence of true trending days, but despite trending days happening more often, neutral and limited auction days, I'm going to repeat this again, are still the higher odd day types at about 54 to 56% of the time. So by avoiding the ranging days and by staying out of the market on the ranging days, it means that A, you're missing out on the vast majority of the days happening and you're giving up way too soon. It's not that there isn't any movement on a ranging day, it's just that the movement doesn't go in a single direction. In particular, in these two products, there's a lot of V-shaped reversals. So you need a different perspective and a better, stronger skill set for looking at the correct trade locations. You need to diversify. Most of my ranging days actually end up more profitable to me than the trending days. So I will typically trade more, but I will reduce my target expectations to account for the fact that there will be lots of up and down movement, but we can take advantage of that. Now, less experienced traders, or those who have not yet worked out how to battle through the ranging day, by the time that they notice that it's a fake out, they already got stopped out once. And now they're attempting a trade in the opposite direction, but they're still getting involved right in the middle of that range. Completely missing the point of what a good trading location means on a range-bound day. So this is where the challenge is. But this is exactly where VWAP can actually help you in a different way. Ranging days require accuracy, timing, and patience. Ranging days, in my opinion, will call for the use of quite low time frames. I typically use like 2 and 5 minute time frames, whereas I normally use like 15 and 30 minutes. And that's not very easy to do. Obviously, the smaller the time frame that you trade, the higher the skill set you have to have. And then when it comes to the trade locations on a range day, you really cannot use anything that averages out the price to slap a line in the middle of the established range. You also cannot use a price action pattern that makes up more than a third of that entire session range that was already established. So right away, 30-minute price patterns will be too big for this purpose. And any other directional type indicator, such as a moving average crossover, which I see a lot, is also very, very inappropriate. You will be totally slaughtered trying to trade through moving averages of any kind on a range-bound day. So my way of using VWAP on a ranging day requires you to kind of think in reverse. It requires you to think backwards. I'm a left-handed person through and through, so naturally I do everything a little bit backwards. And with the ranging days, I try not to rush. So that's the first step. Do not rush. I wait until the price has actually given me enough information. I'm actually really well known by not trading for the first hour of any active trading session, because that is the most random part of the day. You really have to have a very specific type of day to be able to trade that first hour. It's definitely not something that's going to happen every day. And yet the amount of people that trade right at the open immediately, like through and through, it's quite epic. And they lose a lot because of that. However, I like to wait until the price has given me enough information, and then I will use VWAP as an area where I definitely do not want to get involved. For example, here is a chart of gold. I'm using Blahtech VWAP on AMP Futures Metatrader 5. So this is actually a genuine gold futures contract because AMP Futures MT5 uses Secret for their data feed under the covers. The link to Blahtech VWAP is down in the description box. So on a ranging day, the first thing that I will do is to mark the VWAP area. For those of you who are familiar with market profile, especially my market stalker students, VWAP on a neutral day typically tends to align somewhere around the thickest part of the TPO profile on the day. If you're using market profile, you probably won't really need VWAP, but again, it can be useful as a supportive factor. The idea behind staying away from VWAP is to avoid getting involved in the middle of the middle on a ranging day. On days when the market is neutral, like in this example, gold is actually fluctuating greatly in response to some moderate impact news. As a result, the first hour of the trading range, which is marked by this red box here, that first hour of the trading range has extended in both directions, indicating that this is not typically a day when you will get a very strong trend. So instead of getting frustrated and saying, ugh, this is impossible, there are two massive candles and a whipsaw, how are you supposed to trade that? There is a way. So let's take a step back and analyze existing data without the emotions. Where is your high? Where is the low? Where is VWAP? Sometimes it's also useful to know where the edges of that initial first hour of the trading range are. On this chart, like I said, it's this red box. This is Blahtech MP. So we have this graphic overlay on the chart. Now, let's mark VWAP as a no-go zone. There it is, a little orange box. Think of this area as a ghetto of the ranging day. Do not go in there flashing a Rolex and waving wads of cash, because you will get mugged and probably beaten up. To profit on a ranging day, I have a concept of Q points, which are part of my Market Stalkers method, but I also teach it in the crash course called 7 Days to Institutional Order Flow. So I won't be going into that right now, because that's not what this course is about. All of the links for these are down below. But on a ranging day, you need a way to consistently locate originating reversal areas once you've had about 2 hours of active trading. And more skilled traders can sometimes find another opportunity if there is a setup called a failed auction. But again, that's too complex of a subject to go into right now, and it's not what this course is about either. Some data that we can already derive from this chart. Now I'm going to drop down to a low time frame. We actually have, this is a 5-minute time frame. We actually have two very high probability orientation levels. The one at the very top, where the market reversed, is the average daily range or average true range. And then where the market actually started trading actively, we had the edge of the previous day's distribution curve. Now, once the price has bounced the high off of that top area and it started to pull back, once it pulls back to the bottom part of this red box, our previously established low, which, let me remind you, is located at yet another high probability orientation level. So I used the Renko chart to make an educated guess that after the price created this little pop below the previously established area, creating a neutral day, that further downside was limited, statistically speaking. So now it was very low odds that the price will just simply carry on downwards. All I need to do is to find an entry away from VWAP. Now, if I now drop down to a 2-minute chart to show you what went on, the purple line that I put here is VWAP from a 30-minute chart. So you can see that the price went below it and then consolidated right underneath it, where this red arrow is. Now, this consolidation over a number of minutes is what enabled the entry into the long trade. And then we have a typical neutral day behavior where the price acts as if it's an elastic band. It gets pulled back all the way to the high. So that's one trade in the bag. And on this particular day, this move had a pretty decent momentum. So this was about 70 to 80 ticks profit. Even on one contract, we're talking $700 to $800. And that's the kind of movement that's pretty expected for this time of day. So right there, that's your 2R, 2 times risk reward ratio on this first trade. And now we get to the high of the day, up here. So we've migrated all the way back there. And the high actually gets taken out, which is not unusual for neutral days. But it still acts as some kind of a resistance to give us yet another slightly less crazy pullback. And this was now ahead of the New York lunchtime. So there's always a bit of a slowdown. It's like 35 ticks on the way down here. Another $350 in your pocket. So now you're effectively sitting at over $1,000 for the day. 3R profit for the day. So whatever the final trade does, it really won't matter. Because even if you lose the last one, you're still up 2R on the day. But if you can see here, this is a 2-minute chart. So the market still kept weaving up and down. So after the lunchtime was over, the price hits the high again. So here it is. And it reverses again. And this time, because this is now towards the end of the session and the market actually picks up again into settlement. So this is now another run in the opposite direction. Another 2-hour move. So now you're making almost $2,000 with one contract on a ranging day. Just because you need to stay away from the middle and you focused on the highs and the lows instead. Now there is also something called the open sentiment that can help with the odds of having a neutral day to begin with, but I'm not going to go into that yet because that's again a part of another concept called market profile, which is very long. It's a methodology. There are many parts to it. So I have another crash course called 9 Days to Market Profile Trading. Again, very affordable. So if you're interested in raising your skills to a more pro level, that course will help you to start using the auction process properly and to use the market generated information. But this lecture here is, again, just to demonstrate that VWAP is indeed a valuable tool for all sorts of situations, especially for identifying no trade zones on ranging days. Now, depending on the session and the product that you're trading, you might find that if you're trading something that is typically considered out of hours for that particular instrument, for example, trading crude oil during Asia, you may even notice even more neutral ranging days that go up to like 60 and 70% of all sessions. So this kind of approach becomes even more relevant, especially if you're located somewhere in Australasia, but you still might want to take advantage from the USA futures trading companies. Okay, to recap. Yes, it is absolutely possible to profit and smash it, even if we don't have a trending day, which is actually not the norm. Trending days are not the norm. Ranging days are. And yes, this will require skills and a critical eye, experience and knowledge about statistics, and also probabilities of day types. And on a ranging day, you really need to be patient. Don't rush. Let the day develop for a couple of hours. Once you notice that the market is range bound, which usually happens about 55-56% of the time, what you need to do is to mark VWAP and to consider it a no trade zone. Do not attempt reversals in the middle of the middle. Mark VWAP and consider it a no trade zone. Then find the edges of the first hour of the trading range so that you can speculate that it might be a ranging day. If the price moves away from that first hour trading range, then falls back and all the way through to the other side of the first hour trading range. Now, once you've done all that, you need to locate the high and the low of the entire active session. I will emphasize I'm not talking about full days high and low, but rather just the active session. We're intraday traders and each session has entirely different players with entirely different objectives and volumes. And then finally, you want to scan the highs and the lows using tops and bottom zones as your potential turning points, using a small time frame. Because in this case, in the case of a ranging day, waiting for a full-on 15 or 30-minute reversals will greatly increase the odds of your entry being right around VWAP or somewhere in the middle of the range. You don't want that. Now, I will also say that on a ranging day, if you have a decent range, like the example that I've just shown, you can use VWAP as a target as well. If you're interested in more tips on how to improve your own performance, have a sniff around the rest of my channel. There are lots of videos to choose from. I have very useful shorts, I have live trading sessions, I have Q&As, I have podcasts with professional traders and their journeys and their stories, as well as many other very useful pieces of information that can help you in your own trading journey. Enjoy.